Hello, and welcome to Macro Minutes. During each episode, we will be joined by RBC Capital Markets experts to provide high-conviction insights on the latest developments in financial markets and the global economy. Please listen to the end of this recording for important disclosures. Hello, everyone, and welcome to our last edition of Macro Minutes for 2024 called Let It Slow, Let It Slow, Let It Slow. I'm Jason Dyer, your host for today's call, which we're recording at 10 a.m. Eastern Time on December 17th. Before we start, a small housekeeping item. We will resume our regular podcast in January, and we thank all our listeners for your support in 2024, and we wish you and your family a prosperous 2025. Our theme for today's call, Let It Slow, Let It Slow, Let It Slow, fits with various aspects of expected central bank behavior. So the Bank of Canada ended the year with another large rate cut, but they are expected to slow the pace in 2025. While the Fed has already slowed down after an outsized move in September, and they seem locked in to deliver a regular-sized move tomorrow. The ECB should take it slow, and the market is increasingly pricing a slow pace for the Bank of England. Central banks in general should proceed at a variable and uneven pace, reflecting differences in macro fundamentals. So today, Blake's going to kick it off discussing the outlook for the Fed. I'm going to discuss the monetary policy outlook for Canada, and Simon on recent fiscal and issuance developments. Peter's going to review last week's ECB meeting and provide insights on whether the remaining odds of 50 basis points for cuts in early 2025 can be faded, and in the UK, whether the market pricing out more and more Bank of England cuts makes sense. So with that, over to Blake on your thoughts on the Fed tomorrow and going forward.
Thanks, Jason. So as you mentioned up top there, the Fed is set to cut rates by another 25 basis points this week. That's essentially fully priced at this point, but markets are expecting a hawkish skew to the S&P and Powell's comments. But we think those risks around the dots are actually perhaps being slightly understated. That's largely because this meeting comes against a significantly different economic backdrop than the last S&P update in September. Back in September, the FOMC was coming off of multiple downside surprises to inflation. Payroll growth was starting to slow. We had a large negative QCW revision that subtracted a lot of jobs that we thought we had created. The SOM rule had recently triggered, and downside risks generally were seen as rising pretty quickly. So the FOMC responded with a 50 basis point cut, commitment not to get behind the curve, and the SEP showed a pretty big dovish shift, applying a pretty quick convergence with the longer run dot. But since that time, we've had a very notable upward revision in GDI. That's something that Powell himself has flagged as the removal of a large potential downside risk. We've seen improvement in payroll growth. The unemployment rate has basically chopped sideways since that time, and the SOM rule has untriggered, and generally economic data has been coming in above expectations. On the inflation side, the progress we were seeing in Q2 has largely stalled out. On the 3-month average rate, core CPI is rising from 2.0% at the time of the September SEP to 3.6% now. And while the Fed may not care to discuss or admit it, the presidential election has likely injected some tailwinds for both growth and inflation into the 2025 economic outlook. So given how much we've seen this economic backdrop shift since the September FOMC, and the fact that the Fed really hasn't been that shy in making large changes to the dot plot during the cycle, we could see the 2025 median dot moving up 50 basis points to 3.875%. Beyond 2025, I also think the path may show that the longer run median is no longer expected to be reached by 2026. So basically just an even slower convergence with that long run neutral rate. In the SEP in September, the Fed was showing that they basically expected to hit that longer run level for the Fed funds rate in 2026 and then just stay there in 2027. Given the messaging shift towards gradual, cautious, all these kind of keywords we've been seeing from Fed speakers, I think a slower path back to that long run neutral rate wouldn't really come as a surprise. Put another way, I think there's probably a growing acceptance on the committee for one of our long held views, and that's that various impacts from the pandemic, even if they're very long lingering, are likely to keep the short run neutral rate elevated into 2025 and 2026. At the same time, I do think that longer run dot is going to continue to creep higher. We continue to hear from Fed speakers questioning neutral rate estimates, and a lot of those questions are centered around the recent economic resilience and the short run neutral level, but I wouldn't be surprised if those are also bleeding into some of those longer run estimates, and we continue to see that longer run dot plot start to continue to creep higher. Turning to Powell's presser, caution is likely going to be the name of the game. Powell has been very stingy with forward guides of late. Given the amount of uncertainty around next year, we doubt he's going to provide much insight to a potential skip in January. His remarks on current conditions likely are going to echo what we've heard from him in the lead up to the FOMC meeting, which is that the economy is strong, the Fed can afford to move cautiously as they kind of try to find neutral. We'll be paying most attention to his framing on recent inflation prints and upward revisions to the SEP. He had this kind of line that they're well positioned for many potential outcomes. I think that's probably still his main response to any questions about hypothetical economic scenarios going forward. So playing things very, very close to the vest. Lastly, I should note we're cautiously expecting a 5 basis point overnight RRP adjustment. Although there's still a chance that they wait to do that until January. This really doesn't have anything to do with the policy stance. It's all about front-end plumbing and the Fed's ability to control front-end rates. We wrote about this in some considerable depth in a piece last week, so please check out that if you want to know more about this move. It could have some implications for funding spreads, so definitely worth a read. Just as far as how the market is likely to take this, I think it's pretty well priced, well prepared for a hawkish outcome. I think dovishness in the dots, if we are surprised at the dovish side, I think that's probably going to be dismissed to some degree, given that the Fed really isn't incorporating any fiscal or administrative policy expectations into their forecast. So while the market's kind of accounting for this red sweep, the Fed has very clearly stated they're not working that into their base case yet. And Powell, if he were to lean a bit dovish, dismissive of some of the sticky inflation prints, leaning towards risk management approach on labor, et cetera, that's largely par for the course at this point, and I wouldn't think it would come as a major surprise to markets. I would doubt that even if we get a hawkish outcome that we're expecting, that's really going to be enough to drive us out of these post-election yield ranges that we've been stuck in. If we're right on that 50 basis point increase in the 2025 dot, I think we'd probably still get a bit of a front-end sell-off, but that's likely relatively modest. 2025 median showing 2 25 basis point cuts probably reads like a setup for a January skip to markets, but markets have already moved much more hawkish than the Fed. December 2025 is trading very close to the widest levels we've seen relative to the 2025 median dot. As far as longer dated yields, those are much less likely to be impacted in that hawkish scenario. Since the November meeting, we haven't really seen tens trading that closely in line with the odds of a December skip. So as that conversation about a skip kind of rose and fall, long end yields were kind of doing their own thing through that period, and we would expect the same for January. We are a bit closer to the top end of the post-election range in tens, after a bit of a sell-off this morning that we're recording this. But even still, I doubt a hawkish outcome is going to create enough of a momentum to sustainably break through that range and see yields start trading in a higher range into 2025. Once the FOMC is out of the way, I think trading conditions should be full-fledged holiday mode. Fed speaking data are winding down into year-end, and I think markets are unlikely to take any political headlines too seriously, at least until inauguration, and the Trump administration is actually in place, signing executive orders, putting bills on the floor of Congress, etc. So basically expecting noisy, somewhat listless price action post-FOMC as positions are squared into year-end. As far as longer run view on the Fed, we are still expecting a final 25 basis point cut at the January meeting and a long pause that lasts through the entirety of 2025 to start at the March meeting.
So moving over to Canada, the Bank of Canada delivered a 50 basis point cut last week. So that was back-to-back moves in October and December. And we expected them to cut 50, but they did surprise with their policy guidance that essentially raised the bar quite significantly to another large move. So we did think they would downshift from 50 to 25 starting in January, but it was surprising to us in the market that they didn't keep their optionality more open. For January, it seems like we need to see a material positive surprise for them to consider skipping and a large negative surprise for them to do another 50. And put another way, the path for 25 seems very wide at this moment. Today's CPI data, it was quite mixed, to be honest. Core measures were higher, super core was soft, and CPI excluding items like mortgage interest cost showed a benign trend with still overall downside risks going forward. So the inflation data should really be irrelevant in our opinion for what the bank does next month. Growth, that's going to be important, and surely that's going to undershoot the Bank of Canada's Q4 forecast by a wide margin. And in this context, the growing accumulation of excess supply gives the bank probably enough comfort that downside inflation risks are greater than upside ones, and that policy needs to push well into neutral territory and more likely an accommodative stance in our opinion. So looking at market pricing today, it's giving a 70% chance of a 25 basis point cut in January, which makes sense to us. For us, the biggest mispricing right now is what the market's expecting for the Bank of Canada terminal rate. So when you look at the meeting date strip for the Bank of Canada, it only has two more 25 basis point cuts priced in next year. This doesn't really make much sense to us when the macro situation in Canada is pretty dire, but the market's behaving in this way for probably three reasons. First, the most important one being the reductions in rate cut pricing for the Fed. So we are very linked to what happens in the US market, and this has been no exception over the past few months. The second one being investors reducing positions in long Canadian fixed income exposure. It's been a favorite trade for a lot of investors globally and domestically for the past 3, 6, 12 months. So given that a lot has already been delivered, it does make sense to lighten up exposure a little bit. And the third one is the Canadian dollar weakness, which is probably influencing market pricing, but we don't expect it to ultimately influence what the Bank of Canada does. So from our perspective, we think the bank cuts another 125 basis points in 2025, bringing the policy rate down to 2% from 3.25%. And when you compare that to the market pricing of only two more rate cuts and a terminal rate of 275, we think the bar is quite low for the bank to deliver more than what the market's pricing, which means there's still some juice left in the long Canada duration trade and also in the Canada outperformance trade versus treasuries, especially in the front end of the curve. And before passing it along to Simon, I guess, a couple words on politics. There's been some unusual political drama in Canada yesterday with the finance minister resigning just before the fall economic statement. There is growing speculation that Trudeau's days are numbered as the Liberal leader. But I think importantly, if there was a new Liberal leader that was brought in, it does not mean that there necessarily has to be an early election. But the chances of an early election have definitely risen, and a likely window for that would be January to June of next year. Now, from what politics mean for the economy or the Bank of Canada, right now, at least, the Conservatives have a large and probably insurmountable lead in the polls, and they could be handed one of the biggest mandates in Canada's history. So the implications, we think, are pretty straightforward. The Conservatives, when they come into power, would be a little bit more balanced budget friendly than the Liberals. So that would reduce issuance requirements modestly over the medium term. There would be a likely change in the tax and spending mix compared to what we've seen over the past 10 years. And it would probably be a government that would be more conducive to business investment compared to what we've seen over the past decade. So if we get to a point where the Bank of Canada is near the end of the rate cutting cycle and a new government that is maybe a little bit more pro-growth comes into power, that's probably the time when the duration trade in Canada has run its full course. With that, I'll turn it over to Simon for some comments on the budget and the issuance side in Canada.
Thank you very much, Jason. Yeah, so Jason's covered the kind of political developments, but I'll cover the fall economic statement itself. Given the political uncertainty, it's fair to say it's unclear whether that all these measures will ultimately come into place, and certainly the longer-term forecasts that are included are among those. But the fiscal update itself did include deeper deficits over the fiscal plan for last fiscal year 23-24. The big upward revision of $22 billion came from contingent liabilities related to an Indigenous settlement, and so that's not reflective of normal deficit type spending. That's more a matter of that particular settlement. For the current fiscal year 24-25, the deficit was $9 billion higher than was estimated at the budget 2024 in April. However, that's only a couple of billion above the latest estimate from the PBO, which is the budget watchdog in Canada. Important things included in the FES were the GST holiday, which has already come into effect mid-December to mid-February, as well as some tax incentive programs for investment, and $1.3 billion for border security over 6 years, and that's in particular in response to tariff threats from President-elect Trump. Importantly, the pledge to send most working Canadians $250 checks in the early spring was absent from the fiscal update. It remains unclear whether that will ultimately be delivered in a slightly different form at some point or just scrapped altogether. No, on the issuance side, even though this fiscal year saw only a $9 billion increase in the actual deficit, the financial requirement increase relative to budget 2024 was $36 billion higher in total. So that reflected $27 billion of additional non-budgetary financial requirements. So of that, $23 billion will be funded through a higher Treasury bill stock by the end of the fiscal year on March 31st. And some of that already incorporated into the current T-bill stock, which is above the previous fiscal year-end estimate. But we'll focus on the $13 billion that is an increase in bonds, and that will be exclusively in the final fiscal quarter, which is Q1 of calendar 2025. And this will result in $68.5 billion in our estimate for issuance across the different bond sectors, and that would be highest on record on a net basis, so excluding Bank of Canada purchases. This will be spread across the curve, to seeing the biggest increase of $6 billion and actually seeing one additional auction next quarter versus what we've seen this fiscal year so far. 5s and 10s will each see $3 billion increase, so that would mean $1 billion per auction for each of those sectors, and then $1 billion increase for longs or 30-year bonds, and that means $0.5 billion for each auction of the 30s. One thing to note, we do think that this means higher benchmark sizes for the current issuance. So, for example, Feb 27s, we'll see that one additional auction should be at $28 billion rather than $22 billion, while for the current benchmark 10s, these 34s, and 30s, these 55s, we think it means one more auction for each of those bonds relative to what we had previously expected. An important thing to note on this highest net issuance is that QT continues at the Bank of Canada. So we do think that this will end relatively soon in 2025, but it's still ongoing right now. And an important thing to note here, even when QT does end, bond purchases are likely to be a few years away, as the bank has focused on bills and term repos as the first assets to be added as replacement assets when bonds do mature off of the balance sheet and QT is over. Just a quick look ahead to fiscal year 25-26 as well. While we're not, we don't have full estimates for our issuance expectations, we do note that there are $30 billion higher in bond maturities for GOCs in fiscal year 25-26 relative to the current fiscal year. And even though it's a bit less on the other financial requirement side, bond issuance should remain relatively elevated into next fiscal year.
Okay, great. Thanks a lot, Simon. Now over to Peter for insights on the ECB and Bank of England.
Thank you, Jason. So first of all, I'm going to discuss the ECB and the aftermath of the meeting, and then I'm going to review the data that has come in since and preview the Bank of England and obviously what it means for the market. So first of all, the ECB, on balance, on paper, you could have come out with the view that it was a relatively dovish meeting. They cut rates by 25 basis points as expected. They changed the policy statement that could be interpreted in a way that they've been guiding the market for further cuts, and many speakers afterwards have suggested that more rate cuts will be coming. They've also, the new forecasts, they've lowered growth quite a bit and lowered inflation also a tad. And they've even kickstarted a debate about where the landing zone might be, where neutral is. And in that debate, Lagarde mentioned that the lower end of the potential range to be discussed is 175, whereas most market participants would probably have put it at 2. So overall, it has been a relatively dovish meeting, at least on paper. Yet the market reaction was relatively negative. Market sold off afterwards. And in my mind, that goes to show that there's already a very negative perception about the euro area out there. You can clearly see where it comes from. The German economy is not doing well. French politics and finances are a mess. And we get the Trump election, potential tariffs coming. So all of these type of things put fear into investors when it comes to the euro area. And that means you have to be relatively optimistic that the central bank will cut rates. Now, in reality, therefore, however, it was very difficult for the market to rally because the market was probably pre-positioned for this already. And we have started to price out some of the future rate cuts that were in the Euribor strip or in the Ester forwards. Now, going forward, we actually think that the possibility of 50 basis point rate cuts is fairly slim. And nothing in the ECB meeting, or indeed the data that came out, I'll speak about that in a second, suggests that the ECB will have to speed things up. So therefore, we think if you look at particularly the January or also the March meeting and the implied odds, we think that the 50 basis point probability that's still in there needs to be faded. Now, the data that has come out since has actually been decent. Not great, but decent. We had the PMIs, which is a good leading indicator for GDP growth. That was back to where it came from for December reading compared to October. And the November reading, which was very weak, looks a bit like an outlier. Now, that might have something to do with the US elections around the time, because it's a survey of basically purchasing managers' sentiment, and they might have been quite worried. But at the end of the day, the data now bounced back, and when we plug it into our GDP models, it is spitting out round about 0.2 on the quarter, which is where the ECB sits as well. So really no need to speed things up. Now, the other data points that came out were for the UK. And this is really interesting because I think this gives us a bit of a glimpse into what might lie ahead. The labor market data in particular that came out today on the 17th when we're recording was relatively strong, even though it needs to be taken with a pinch of salt, given that the data quality is not that strong. And particularly the wage data was relatively firm. Now, the market has reacted very strongly. It has priced out about 15 basis points of rate cuts out of 25. And we're now pricing in just a little over 2 rate cuts for the whole of next year. Whereas we are expecting, and most of the people in the market are expecting, about 100. So what we think is therefore that the UK market is probably one of the few markets that is underpriced. However, what it also shows is that here in Europe, this combination that we've also spoken about in our Outlook edition of this podcast, where we have full employment, relatively decent wage growth as a response, yet mega growth because our productivity growth is low, is a situation that the central banks probably cannot simply ignore. And it would make it very difficult for central banks, despite growth being relatively weak, to cut rates very aggressively, because even weak growth can lead to implicit inflation pressures. And that's exactly what seems to be playing out in the SONIA market at the moment, on the sterling market, and might well be a blueprint of what might be to come for 2025 for the euro market as well, where the market currently, as I was saying earlier, has a very, very aggressive view what the central bank might be doing. So long story short, we have been cautious on duration in Europe, and we continue to do so, both in sterling as well as in euros. And that's the main thesis. And we think that particularly in euros, the market is too optimistic what the central bank might be delivering.
Okay, thank you, Peter, and thank you to all our listeners for tuning into this edition of Macro Minutes. Macro and monetary policy, they are going to remain a hot topic in 2025, so please reach out to your sales representative or us directly for further insights.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.